Freeberg is saying that the Treasury is going to have to do another $2 trillion bond offering. And we have $1 trillion plus deficits as far as the eye can see. And we've got entitlement liabilities on the horizon and then a political unwillingness to do anything about it. So the deficits are only going to get bigger and bigger. Now, what does that do? It's supply and demand. When the U.S. Treasury needs to keep issuing more and more bonds, at some point, the demand for those things gets incrementally saturated, and they have to offer a higher yield. So what happens? Well, the bond rates go up, and so the 10-year goes up, like Freeberg was saying, from 4.2 to somewhere in the 5 to 7% range. And that doesn't mean the U.S. dollar is not the world's reserve currency. It just means that it gets incrementally harder and more expensive to keep financing our debt. Now, what is the result of that? Well, if I, as an investor, could theoretically get 7% from the U.S. Treasury as the risk-free rate, why would I want to take equity risk and put it in the stock market, which historically has yielded somewhere in the 5 to 7% range? So if I can get my 5 to 7% from a risk-free U.S. government bond, of course I'm going to do that. So the discount rate on equities will go up. That means that the stock market on a relative basis will go down.
Risk capital will go down. There will be less risk capital.
Will go down, and there'll be way less risk capital available for things like venture capital and private equity, just risk-taking of all kinds. And so the economy will just grow slower. It's not like there'll be a collapse. It'll just be this huge albatross around the neck of the private sector. And this is called crowding out.